The silver market is taking a hit today, down $2 as we speak. Is the silver squeeze over? That's the question on most people's minds right now. Peter Hug, Global Trading Director of Kitco Metals, joins us today. Peter, help us break down what's going on right now in the markets.
Well, it started, obviously it started last Wednesday with the first Reddit post that they were trying to mobilize retail investors to try to squeeze the silver market. And they managed by Friday close to get the market up around $2 from Wednesday's close. And then I think they came up with another strategy that if they hit the dealers on the weekend when the markets were closed, the dealers would be forced to cover on Sunday night and move the market higher. And if you recall our conversation from Friday, I suggested that might work and might take silver up, to $30, maybe 32. We got to 30. Subsequently, yesterday when the market opened, we gave back approximately $1.50, and this morning we gave back another $1.50. And we're sitting in the mid 26s, which is still about $1 higher than it was last Wednesday when this first started. But the market has definitely softened back down. Again, as I warned on Friday, it's one thing buying silver at 27 if you're a medium to long-term investor, because I'm still, from a macro perspective, bullish silver in 2021. From a trading perspective, much along the lines of GameStop, great if you got in at 20 and sold it at 550. Not very nice if you got in at 550 and it's now sitting at 200. Now, what the problem is here is what this caused by this surge of retail demand was it literally wiped out small inventories of silver in the coin and in the bar market over the weekend. I mean, literally every dealer that was on the list sold their entire silver inventory. So what that has caused, as opposed to silver going to $35, you just cannot, with retail, have the buying power to force the market up beyond fundamentals, and the fundamentals don't substantiate short-term that type of a move. What that did, though, was it wiped out the silver inventories. Now there are no silver inventories of small investment bars on the market. So people that bought on the weekend were paying premiums anywhere from $4 to $10 an ounce over silver. Now there's no inventory. So the premiums on coins and bars are now similar to what they were in March of last year. So any type of pullback in this market now, unless investors get involved in the ETF or futures market, there's really no inventory to buy to be able to add to positions. So, they sort of cut off their nose to spite their face. And the problem with the futures market is, and this was inevitable as well, when you get this volatility, is this morning the CME raised margins. So that created a situation for people that were long silver at the open Sunday night at the 29.5 to 30.5 range. Now they saw silver come down, plus margins were increased, so now they're forced to liquidate. So now you've got a cascading event going the other way, and we're almost back to where we were before. This whole story of let's try to squeeze the big players out.
Sorry, Peter, who's liquidating? Who's liquidating, Peter?
Well, people that bought futures contracts paid $29, $50, $30 on Sunday night when the market opened after 6 o'clock. Had normal margin requirements, or the margin requirements that were in place on Sunday. This morning, the CME raised those margins. So you're hit with a double whammy if you were long silver at 30. First of all, you have a loss because silver's now trading south of 27. But now the margin requirements have gone up. So when you meet margin, you have to pay double the margin to keep your position alive. And a lot of medium, smaller investors that got involved in the futures markets just can't afford to come up with that kind of a margin call. So you have liquidations going into the market, and it's causing a cascading effect to the downside.
Yeah. Okay. Let's talk about that in just a minute. I want to go back to the inventory side for just a bit. Now, on Sunday, I know you were swamped. I tried to get a hold of you. You weren't even available for a comment because you were just so busy. One of the questions I got from viewers, this is a fair question, is for the dealers, instead of filling in orders after the fact or backordering backdating orders or perhaps rejecting orders altogether, why not just raise the premium? Why not just raise the price?
They did. Premiums went way up on the weekend. All the
Okay.
dealers adjusted their premiums based on their book because their books were going short throughout the whole weekend and premiums were going higher.
Right.
But
And they
then
still sold out, you said, even
yeah,
despite.
I think again I can't be exact because all the dealers were different on this, but sometime early Sunday morning, almost every dealer had posted something on their site that they were no longer taking silver orders. I mean, our site basically, from just a technical perspective, was just overwhelmed with the orders. And you have to get to a point where there's a cutoff time when you are sort of forced to reject any orders over and above because you're at a point where you just don't know whether you have the inventory to meet. And the last thing you want to do is make a guarantee to a client that you're going to deliver a product and you've oversold the product. Now, inventory deliveries right now, the U.S. Mint is anemic on delivering Silver Eagles right now. The Canadian Mint has been on allocation for the past 6 months.
Yeah.
Any dealer that's out there selling silver 4 to 6 weeks out, which is what some of them were doing pre-last Wednesday, are now, in my opinion, going to have a significant issue in trying to figure out how to make good on delivering product with any kind of reasonable time window. We were fortunate. We basically just we were able to cut it off. There was a small issue on our end. We've allowed clients to come in and make themselves whole again if they wanted to, but it was a major problem. Now we were also fortunate because I could, again, I'm not psychic or anything, but I could almost see this coming. And so we do have a relatively good supply still of 100-ounce silver bars, which we were able to get first thing Monday morning, and very incidental supplies of the small stuff like silver maples, silver eagles, and some smaller silver product. So we do have some 100-ounce silver bars in stock. You can check all of the other dealer, and these are RCM 100-ounce silver bars. You can check all the other dealers there. None of them have 100-ounce silver bars in stock. And so that is still available from a physical perspective. But generally, the market has been completely wiped out of small investment grade silver product.
Peter, are you anticipating this demand surge to continue? Is this sustainable just on the physical front?
Well, I think if dealers have physical silver inventory, I still think there's a demand component out there. This was out there prior to the Reddit posts. I mean, it was difficult. If you go back 3 or 4 of my posts over the past few weeks, silver inventories were tight. And as we were getting in eagles and maples and 100-ounce bars and 10-ounce bars, they were moving fairly briskly before this happened. So I would imagine that the sort of retail demand on a macro picture is still there. The problem is there's no inventory there.
Okay.
So now the premiums have gone. I mean, silver maple leaf premiums were at, memory serves me, somewhere around $3 over spot on Thursday, Friday last week. Now they're at $8. 100-ounce silver bar premiums were at $1.75. Now they're at $5. So basically this intent to try to squeeze the market, which was, I don't want to use the wrong words here, but was absolutely silly, has now backfired, and now there's no retail product in the market, and the premiums are pre-COVID or at March levels of last year.
And you don't think the premiums will normalize anytime soon, within the next 2 weeks?
You can't normalize premiums until you've got a solid supply chain.
Okay.
And right now the supply chain is probably 4 to 8 weeks out. So I mean, how do you set your premiums?
Yeah. Okay.
Without knowing where what kind of volatility we're looking at going forward. So what the dealers do is they just jack the premiums up. They cover their positions in 1,000-ounce bars because those are readily available. And then when the product comes in, they'll swap their 1,000-ounce bars for the product because they will still get that product at distribution prices. And in the interim, they've covered their position. so they're not exposed to the market. But individual clients looking for product are going to have to wait or pay through the nose if they find any dealer that has inventory.
Let's talk about the futures and regulations now, finally, Peter. So going back to the CME's regulation, I'm just going to read the statement. So they've risen margins from $14,000 to $16,500 per contract, effective today, February 2nd. And the statement says the normal review of market volatility to ensure adequate collateral coverage. That was the basis of their decision. Is it normal for the CME to raise collateral during market volatility?
Oh, absolutely. Yeah. Whether the market goes down or up, they're going to they'll raise margins. Quite frankly, I'm surprised that they only raised it 2,500. I mean, on a 5,000 ounce contract, if you had gotten in Sunday night and based on where it is right now, 5,000 ounces, you'd be out almost $20,000 if you bought the high on Sunday night. And they've only raised the margin $2,500. It would not surprise me if the volatility continues, that margin will not go higher.
All right. CFTC has also issued a statement last night. It says, I'm just going to read their statement. The commission is communicating with fellow regulators, the exchanges, and stakeholders to address any potential threats to the integrity of the derivatives market for silver. It says the CFTC is closely monitoring recent activity. Should the regulators be involved? Is there any cause for concern on the regulatory front, Peter?
It's. I don't think they're worried about something untoward from a trading perspective in the futures market. I think what they're worried about is somebody that's got it's almost like the Robin Hood type of thing, where clients have got significant positions with their brokers on the futures contract, and today there is going to be a significant margin call. With this drop. And when this margin call comes, clients are going to have to pony up. And if they don't pony up, it's the broker that has the liability. Now, they can go after clients individually, but they have the liability. And I would suspect that some of these accounts may be underwater from the perspective of having assets on account to meet this margin call. Again, just on 5,000 ounces of silver, if you got in at the top, you'd be out almost $20,000 on that trade. So you can imagine if you multiply that by increments of 500, 1,000, or 5,000 contracts, there's a significant loss in this market. And if the clients don't have collateral with the broker, or the broker has access to cash, the broker is going to be on the line to meet that margin call with the CME when they come out this afternoon. So from that perspective, I can understand why the regulators might be concerned. I think it's nothing to panic over yet, but it is a concern from a liquidity perspective.
Okay, final question now, Peter. We've already seen silver go down $2 today. Do you have any more anticipations of where it could go short term? What's next?
I like silver. I mean, I told you guys at 25.50, I like silver. I like the macro picture. I think, whether the Biden gets the Republican support or not, he is going to put through this package. And given his Green Deal package, everything from a macro picture going forward in 2021. And then if you add in the possibility that, these vaccines really get the economy going again, and then inflation starts to pick up second half of this year, I am, from a macro perspective, still very constructive to metals. Short term, will we see a 25 handle? Absolutely possible. But if you are an investor and you have not engaged in this market and you want a portion of your assets in precious metals, the mid 25s I still think are a good value for silver, and certainly gold in sort of the 1800, 1850 level is certainly a place where I would add to my position.
Peter, thanks so much for coming in with your updates. Appreciate it.
Thanks a lot, and good luck to everyone.
Yeah, thank you. And thank you for watching Kitco News. I'm David Lin.
Why silver may have staved off the GameStop effect, according to Granite Shares CEO. Silver may have staved off the worst of its speculative frenzy. The precious metal retreated from 8-year highs on Tuesday after Reddit-fueled traders set their sights on the metals market in Monday's session, driving the price of silver up 8% in a day. But while retail traders may have been responsible for recent double and triple-digit percentage moves in stocks including GameStop, their short squeeze play may not work on silver, Granite Shares founder and CEO William Wren told CNBC's ETF Edge on Monday. "I don't think what happened in GameStop will happen to something like silver," said Rand, whose firm runs the Granite Shares Bloomberg Commodity Broad Strategy ETF, COME, 5% of which is invested in the metal. While silver is perceived as having high short activity from professional investors and the banks providing an ideal villain for the speculative crowd, the majority of it is legitimate, Wren said. Banks are short the silver market because they have very legitimate commercial interests in doing so, he said. They borrow metal, silver, from the market for their customers. Those customers could be refiners, they could be mining companies, but typically, it's legitimate activity. Though regulators have loosened some trading restrictions in the last year, the Volcker rule, which largely banned proprietary trading by banks, is still in place to limit the exact same activity that retail investors are now claiming still exists within the banks, the CEO said. And the silver market's safeguards don't stop there, Wren said. He estimated that the market cap for physical silver is worth some $30 billion, nearly 20 times larger than GameStop's was before its meteoric rise. The silver market is also flush with supply, be it in the professional market, be it futures or also physical supply via recycling coming back into the market at higher prices, he said. There are also the regulators, particularly the Commodity Futures Trading Commission and the exchanges, who set margin requirements with the goal of limiting risk and volatility, he said. The Chicago Mercantile Exchange increased its margins for silver on Tuesday to normalize for the rising volatility. COME hit a high not seen since December 27, 2019, in early Tuesday trading. The iShares Silver Trust, SLV, fell more than 7%.